Inflation is the most genius wealth extraction system ever invented because you don't feel it happening. Here's what I mean. Back in 2020, Tom retired with what he thought was a bulletproof plan. He had his house paid off, a pension paying him $4,000 a month, and about $200,000 in savings. 5 years later, he's sitting at his kitchen table doing the math, and he realizes something horrifying. His pension still says $4,000, but his grocery bill went from $300 a month to $425. His property tax went from $3,800 a year to $5,200. His homeowner's insurance doubled. His Medicare premium jumped. And here's the kicker. Nobody raised his taxes. Nobody cut his pension. The numbers on paper look exactly the same. But he's losing ground every single month, and there's not a damn thing he can do about it. I'm going to walk you through exactly how this works, why it's accelerating, and what you can actually do about it. Because the uncomfortable truth is that the retirement security you think you have is being quietly extracted through 3 invisible mechanisms that compound on each other. And by the end of this, you're going to see your financial situation completely differently. Think of it like this. Imagine you're driving on a toll road, but the toll booths are invisible. You can't see them, you never stop at them, but every few miles, money is being automatically deducted from your account. You notice your balance going down faster than you expected, but because you never saw a toll booth, you can't quite figure out where it's going. That's exactly how these stealth taxes work. They're not line items on a bill you can protest. They're built into the system itself. The first toll booth is property tax. Now, you might be thinking, hold on, I see my property tax bill every year. How is that stealthy? Here's the thing. It's stealthy because you have zero control over it, and it's designed to grow faster than your income in retirement. Let me tell you about my neighbor, Susan. She bought her house in 2005 for $220,000. Her property tax that year was $2,600. Today, that same house is assessed at $480,000. Her property tax is now $6,800. That's a 162% increase. Her Social Security went up maybe 30% in that same period. But here's what makes this particularly insidious. About 80% of people over 60 own their homes. We were told this was the dream, right? Pay off the house, own it free and clear, and you've got security. Except you never really own it. Stop paying property tax and see how long you keep that house. The state effectively has a permanent lien on your property, and they can increase that lien whenever they want by reassessing the value. You know what they call that in the private sector? A protection racket. Now, the incentive structure here is fascinating. Local governments need revenue. They can't print money like the federal government. So they're trapped between angry voters who don't want higher tax rates and budget shortfalls. The solution? Keep the rate the same, but reassess property values upward. It's a tax increase without calling it a tax increase. And because home values have been going up, especially in the last few years, they've got cover. Oh, we're just accurately reflecting market value. Sure, but here's the problem. Your house going up in value doesn't help you unless you sell it. And if you sell it, where are you going to live? Every other house went up too. A guy I knew from my old job, Frank, he bought a little ranch house in Phoenix back in the 90s. 15 years into retirement, his property taxes had tripled. His pension hadn't. He ended up selling and moving to a cheaper state, but guess what? Property taxes in the cheaper state were also climbing. He didn't escape the toll booth, he just found one with a slightly lower rate. This is where it gets really interesting. Property tax is the visible one. You at least see the bill. The second toll booth is completely invisible while it's happening, and it's the most destructive one, inflation. Not the inflation rate you hear on the news. The inflation you actually experience in your life. Here's a story. I was talking to a guy at the coffee shop last month, retired teacher, 72 years old. He told me he retired in 2020 with a pension of $4,800 a month. It was enough back then, comfortable. 5 years later, his pension still says $4,800. But between 2020 and now, aggregate inflation ran about 25%. That means his $4,800 buys what $3,600 bought when he retired. He didn't get a pay cut. On paper, his income is stable, but he lost $1,200 a month of purchasing power, and nobody sent him a letter explaining it. Now you might be thinking, okay, but inflation is just economics. It's not a tax. Wrong. Inflation is absolutely a tax, and here's why. The government controls monetary policy through the Federal Reserve. When they print money, when they expand the money supply, they're diluting the value of every dollar you hold. It's the same thing as if they came to your house and said, "We're taking 25% of your savings." Except it's slower, it's quiet, and you can't see it happening until it's already done. But here's the incentive at play. The government loves inflation. You know why? Because the government is the largest debtor in the country. They owe $36 trillion. When they inflate the currency, they're paying back that debt with cheaper dollars. If I borrow $100,000 from you today and pay you back in 10 years, but inflation ran 50% in that decade, I'm effectively paying you back $50,000 in real terms. I got a 50% discount on my debt. You got robbed of 50% of your principal. So the government has a massive incentive to keep inflation running hot, not too hot, or people revolt, but a nice steady 3 to 4% annually. Over 20 years, at 3%, your purchasing power gets cut in half. Your savings, your pension, your fixed income, all worth half what it was. Meanwhile, the government's debt burden just got 50% lighter. And here's the kicker. They measure inflation using the Consumer Price Index, which is specifically engineered to underreport the real inflation you experience. They use something called hedonic adjustments and substitution. Let's say steak goes up in price. The CPI assumes you'll just buy chicken instead, so they substitute chicken in the calculation. But you didn't want chicken, you wanted steak. Your standard of living just dropped, but the inflation number didn't capture it. Or let's say your computer costs the same as it did 5 years ago, but now it's faster. They adjust for that quality improvement and say, actually, the price went down, but you were going to buy a new computer anyway. You didn't get a deal. I read about a study from the Chapwood Index that tracks the real cost of the top 500 items people actually buy in the 50 largest cities. Their number? Inflation has been running closer to 9 to 12% annually in many cities, not the 2 to 3% the government reports. If that's even close to accurate, your money is losing half its value every 6 to 8 years. Now, the third toll booth is the one that almost nobody sees coming until they're already through it, and it's brutal. This one's called Medicare Premium Creep, and it's got a special surprise inside called IRMA, Income Related Monthly Adjustment Amount. I love how they name these things to sound boring so you won't pay attention. Here's how this works. You retire, you're on Medicare, and you think, okay, my premium is $174 a month. I budgeted for that. But there are two problems. First, that premium goes up every year, and it goes up faster than your Social Security cost of living adjustment. In 2025, Medicare premiums went up enough that a lot of people saw zero increase in their Social Security check. The entire COLA got eaten by the premium increase. Toll booth number 3 just took your raise. But wait, it gets better. If your modified adjusted gross income from 2 years ago was above certain thresholds, you pay a surcharge on top of that premium. That's IRMA. The thresholds start at $97,000 for an individual, $194,000 for a couple. Hit that, and your premium can jump to $244 a month. Go higher, and it can hit $349 or $454 or even $607 a month. Now, you might be thinking, okay, but that only hits higher earners. Sure, but here's the trap. It's based on income from 2 years ago. So let's say you're 69 years old and you decide to sell some stock to remodel your kitchen. Or you take a big distribution from your 401k to pay off a debt. Or you convert some of your IRA to a Roth. Boom, your income spikes that year. 2 years later, you get a letter from Medicare saying, congratulations, your premium is now $454 a month. You didn't plan for that. You can't undo the withdrawal. And here's the insane part. If you call the government and ask them, hey, what are the IRMAA thresholds going to be in 2 years so I can plan around them, they can't tell you. They don't set them until the year they apply. You're flying blind. I know a couple, retired in 2022, nice people, saved well. They sold a rental property in 2023. It put them over the IRMAA threshold. In 2025, their combined Medicare premiums jumped from $348 a month to over $900. They're locked into that for the entire year. That's an extra $6,600 they didn't budget for. Invisible toll booth. But now you might think, okay, Bobby, this is depressing, but what's the point? We can't control any of this. And that's partially true. But here's where it gets really interesting. These three mechanisms don't just coexist. They compound on each other. Let me show you what I mean with real numbers. Let's take a hypothetical retiree. We'll call her Margaret. She retired in 2020 at age 65. She's got a pension of $5,000 a month, $60,000 a year. Social Security adds another $24,000. Total income, $84,000. She owns her home outright. Property tax is $4,000 a year. Medicare premium, standard, about $2,000 a year. Homeowners insurance, $1,800. Maintenance, utilities, food, gas, normal expenses, let's say another $40,000. She's spending about $66,000 a year. She's got $18,000 left over. She feels comfortable. Fast forward to 2026, 6 years. Her pension, still $5,000 a month. Pensions don't adjust for inflation unless you're a federal employee or have a rare union deal. Social Security went up with COLA, maybe it's $28,000 now. Total income, $88,000. Sounds like she's ahead, right? But let's look at expenses. Inflation ran about 25% aggregate, but for retirees, it's worse because healthcare and housing inflate faster. Let's be conservative and call it 30%. Her property tax went from $4,000 to $5,200 because the county reassessed. Homeowners insurance doubled in many states due to climate claims and reinsurance costs. Let's say hers went from $1,800 to $3,600. Medicare premium increased, now about $2,600 a year. Her normal expenses that were $40,000 are now $52,000 with inflation. Let's add it up. Property tax, $5,200. Insurance, $3,600. Medicare, $2,600. Normal expenses, $52,000. Total, $63,400. Income, $88,000. She's still got about $24,000 left over. On paper, she's actually better off than she was in 2020. She's got $6,000 more in surplus. But here's the trick. That's nominal dollars. In real purchasing power, accounting for inflation, her surplus of $24,000 in 2026 dollars is equivalent to about $18,000 in 2020 dollars. She actually lost ground, and we haven't even factored in Irma because her income is still under the threshold. But if she has any irregular income, a stock sale, a required minimum distribution from a 401k when she hits 73, she could easily trip that wire and lose another few thousand to the IRMAA surcharge. Over 10 years, this quietly turns into a crisis. If these trends continue, by 2030, Margaret's expenses could be $75,000 to $80,000, but her income will be maybe $95,000 if Social Security keeps pace. Her buffer disappears. She starts eating into savings. The savings she thought would last 20 years might last 12. Now, here's the part that should make you angry. None of this is accidental. The system is designed this way. It's not a bug, it's a feature. Governments need revenue, but they've learned that voters hate explicit tax increases, so they use invisible ones. Inflation? That's a tax that doesn't require a vote. Property reassessments? That's a tax increase without calling it one. Medicare premium increases tied to inflation? Same thing. IRMAA? That's a stealth surtax on people who saved and invested, which is darkly funny because those are the people who are supposed to be responsible. You want to know what's even more cynical? There's a phrase in policy circles. They call it fiscal drag. It's when tax thresholds don't adjust for inflation. So over time, more and more people get pushed into higher brackets or new surcharges, even though their real income didn't change. IRMAA thresholds barely moved in a decade. The threshold in 2023 was $97,000. In 2026, it's still basically there. But the median household income climbed with inflation. So every year, more people trip that wire. It's by design. Here's a quick aside. I was at the DMV last year, and the guy in front of me was losing his mind because his registration fee went up $40. $40. Meanwhile, He probably lost $5,000 to inflation that year and didn't even notice. We're wired to hate visible costs and ignore invisible ones. The system knows this and exploits it ruthlessly. Another one. I have a buddy who keeps all his money in a savings account earning 1% interest because he thinks the stock market is risky. I tried explaining to him that he's losing 3 to 4% a year to inflation, so his safe savings account is actually a guaranteed loss of purchasing power. He looked at me like I was speaking a foreign language. The bank statement says the number went up. That's all he sees. Okay, so what do you actually do about this? I'm not going to give you some nonsense about buying gold or moving to Panama. Here are 3 real takeaways. First, you have to build inflation into your retirement plan, and you have to assume it's going to be higher than the government says. Don't plan for 2%, plan for 4. Maybe 5 for healthcare costs. If you're using a calculator or working with an advisor, force them to model what happens if inflation runs at 4% for the next 20 years. Most people model at 2 and then act surprised when they run out of money at age 85. Inflation is not going away. It's the government's solution to the debt problem, and you're the one paying for it. Second, you need income sources that adjust. Social Security adjusts, sort of. Pensions usually don't. If you're relying on a fixed pension, you're standing still while the toll booths get more expensive every year. That means you need assets that can grow or generate increasing income. Could be stocks, could be rental income, if you're careful about property tax, could be part-time work if you're healthy enough. I know that's not what you wanted to hear. You wanted to retire and be done, but the math doesn't care what you wanted. Third, get strategic about IR, MAA, and required minimum distributions. If you've got a big 401k or IRA, those required minimum distributions start at 73, and they can spike your income right into IRMA A territory. Talk to someone who actually understands the rules. Maybe it makes sense to do Roth conversions earlier in smaller amounts to avoid a giant RMD later. Maybe it makes sense to draw down taxable accounts first. I'm not giving specific advice because everyone's situation is different, but most people sleepwalk into this and then act shocked when their Medicare premium triples. Look, the brutal reality is this. The system is not designed for you to win. It's designed to extract. The government needs revenue, and they figured out that the best way to get it is through mechanisms you don't see, can't avoid, and won't protest because you don't realize it's happening until it's too late. Inflation taxes your savings without a vote, property taxes grow faster than your income, and you can't opt out. Medicare premiums eat your Social Security increases and punish you for having a decent income. These aren't 3 separate problems. They're 3 parts of the same machine. And here's the final cynical line. You know what the real genius of it is? By the time you figure out what happened, you're too old to do anything about it. The toll booths already got their cut.